Today, I present to you the craziest and one of the worst performing stocks of all time. And this is WBD. The stock has been all over the place. It went up to, $71, $72 whenever Bill Huang was leveraging up and he was pushing the stock way, way up. And now the stock is sitting at $7.36 per share. A lot of maybe AT&T investors are still stuck with the shares whenever Discovery and Warner Brothers merged. And this is a stock I used to own. I sold it in 2022. A lot of you know, around 13.50. I lost 26 or 27%, I believe, on WBD, and ended up buying Google at 85, and ended up being a good move. But WBD is a crazy stock. I mean, the stock never goes up. A lot of popular investors like Seth Klarman, he bought it, he gave up on it, he sold it 100%. Michael Burry, he owned it for a while, then he sold it 100%, and it's crazy. I mean, and the stock keeps going down. The S&P goes up 10-15%. WBD is down. The S&P goes down, and WBD goes down even more. So the question is, what is it going to take? When will WBD finally be realized in terms of the value? Because the stock is undervalued and it's an amazing free cash flow machine, but the market isn't really realizing the value. And I'm going to tell you why, and I'm going to give you an update on it since a lot of you have asked me about my opinion on WBD, and I got a lot of questions on Occidental Petroleum. And I'm going to do my best to give you guys what you want and do the analysis for you. Now, for the last earnings report, it was terrible. They missed, even it was a loss, 36 cents loss versus a 22 cents loss. It was absolutely terrible. They also missed on revenues. It was very, very bad. And one of the reasons for the big loss is they had to take a $9.1 billion non-cash impairment charge on the TV networks business. Now, it's no secret that the traditional old school TV networks, they're declining. Most of them are declining, and people are watching more DTC, direct to consumer stuff. They're watching YouTube, they're watching Netflix, they're watching different shows and different stuff. They're not really watching cable. So cable is declining in total, and this is well known. But one of the reasons that has contributed to this massive $9.1 billion impairment charge is Warner Brothers Discovery losing the key NBA rights for them. They used to, show up for years and years, and now they lost the right. And it was a $77 billion deal. Disney, Comcast, and Amazon, they both participated in the deal, but WBD lost the key rights. And this is a big deal because the company used to air it on the TNT network since 1989. This is a long history between NBA and WBD, and now this is over. And of course, it's going to diminish the value of the network a lot. And this is one of the reasons why they had to take this impairment charge. And WBD did try to match Amazon's rights in terms of the bid. They did try to get pretty much the same thing, but NBA has denied the offer, and they said they didn't really match the term of Amazon's Prime Video. So WBD right now is trying to sue the NBA for not accepting the offer because they're claiming that it was the same exact offer as Amazon, but NBA chose not to go with WBD and they went with Amazon. And Amazon is a stock that I like very, very much, and I discussed it. But I would doubt this would go anywhere. I mean, I don't think they're gonna be in trouble, the NBA, for rejecting WBD and accepting Amazon. I mean, I don't really think so. But it's really bad. There's a lot of bad stuff that's happening in the company, but there's a lot of good things that's also happening in the company. I'm gonna talk about a few of them. The first one is DTC, direct to consumer subscribers. They're also increasing a lot from 96 to 99.6 to 103.3, 103 million worldwide subscribers. United States hasn't really been doing the best. They declined a little bit. But in terms of international subscriber, this is where WBD has been shining, and they've been increasing subscribers rapidly. And global average revenue per user did increase pretty much steadily on every single quarter. And that was very good. So that's very good news from WBD. But the company is still losing money in this segment, and the losses have even increased from 2023 to 2024. And this is really disappointing a little bit because David Zaslav was focused on profitable growth. This is what he said. He wants to cut off all the unprofitable projects and invest in things that are profitable. And it's really not good at all. And if you look at the revenues in general or the business model, it isn't really the best because they took $2.5 billion in revenues. Their cost of revenues for producing and all that stuff is like $2 billion. And the rest is like just selling general administrative 647. So out of two and a half, they took two cost of revenues. I mean, this is not the highest margin business model ever, I would say. It's very hard for most companies to make it work like Netflix did. And WBD is trying their best and they're improving, but they still have long ways to go. Now, one of the big improvements that the companies have done, and that has been amazing, and it's mainly rapid deleveraging. This was the most important part of WBD, and net debt went from $53 billion to $37 billion as of the last quarter. And this is very encouraging. This is pretty amazing from the company. They still have very high interest expense, around $500 to $522 million as of the last quarter, or as second quarter of 2024. So this is around $2 billion a year in interest expense. And I did some calculations and I'm gonna try to share them with you. Okay. Now, if we look at the free cash flow, this year is gonna be terrible, mainly because of the impairment and the revenues declined 7%. And things aren't going the best this year. And most media companies are suffering some kind of a slowdown, along with a lot of, just advertising stuff and retailers and consumer discretionary stuff in general. They're facing some challenges, and WBD is also facing challenges. And free cash flow has dropped from 6.1 billion to around 4.1 billion for 2024, as expected. That's expected to rebound to 5 and 5.4. But I'm not really gonna care much about those numbers. I'm just gonna focus on the $4.1 billion, or mainly $4 billion even. And I did some calculations. And if WBD continues using 100% of their free cash flow to pay down the debt, and they use it for the next 5 years, and assuming free cash flow does not expand, it stays the same, around $4 billion. It doesn't go to 5.5. It stays at $4 billion. This is $20 billion over the next 5 years. Now, if WBD can pay off $20 billion of debt, and their weighted average, I should say, interest rate is around 4.5%, in my opinion, because they have some at 4, 4.3, and 5.9. Most of it is at 5.9. So I think the average is like 4.5. Okay, so taking the $20 billion, assuming they paid it off over the next 5 years, and 4.5% interest rate, this is around $900 million saved in interest expense. So you add the $900 million to the $4 billion, that would take the free cash flow pretty close to $5 billion over the next 5 years. And it would take the enterprise value down by $20 billion because they paid off $20 billion of debt. And it would take it to $37 billion 5 years from now. Now, taking the $5 billion of free cash flow and the $37 billion of enterprise value, it would put WBD at a valuation of 7.5 times free cash flow. So enterprise value to free cash flow would be 7.5 times. This is like I believe it's like a 15 or 16% free cash flow yield, even a little bit higher. And that's extremely, extremely cheap for the company. And they would be in an amazing position to buy back stock at 7.5 times free cash flow. That would be dirt cheap, and it's just impossible. So, in my opinion, if WBD does get to this position in terms of deleveraging, I could easily see the company trading at 15 times free cash flow, which would be 100% over the next 5 years instead of 7.5. And even at 15 times free cash flow, the company would finally be in a position to incentivize investor for them to be invested in the company. They could start a dividend, they could do buybacks. Now there's no reason to be invested in WBD while you could hold other stocks. You could put in treasuries 5%, get 5.5%. You're not getting that with WBD, and you're not getting revenue growth. So it's more of a stock that's really meant for like deep value investors that believe in the turnaround and have a lot of patience. But if you're patient on WBD and they could pay off 20 billion of debt and they can start buying back stock, returning value to shareholders as interest rates come down, it's going to look more appealing to a lot of investors. So for me personally, even though I don't own WBD, and I don't own it because I lost money on it, and I have like a rule in my portfolio where if I lost money or something, I don't go back. I know it sounds stupid, but that's just how I do it. And you do what's best for you, but that's what I do. But if I'd never owned it, I would be buying here. I'm just being honest. I like it very much. I think the management is doing good in terms of paying down the debt. They could do a little bit better, of course. They lost the NBA, which is really, really bad. And I'm not sure what's going to happen. But for me personally, it looks very good over here. So I like it. And relative to other opportunities, maybe it's not the best. Maybe there's better opportunities in the market. But as a value investment kind of turnaround, I think WBD, looks very good. But you need a lot of patience because the stock has been, I mean, everyone gave up on it. So if you're still holding it, I mean, you have a lot of courage. That's all I can say. But this is my opinion on WBD. I hope you enjoyed it, not financial advice. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.